The Minority Market. Episode 74. How to Observe Without Reacting. Most people do not lose money in the stock market because they lack intelligence. They lose because they react emotionally. The market is designed to stimulate human instincts: fear during falls, greed during rallies, impatience during sideways movement, and hope during uncertainty. These emotions push people into poor decisions. The minority learns one rare skill that changes everything: the ability to observe without reacting. Observation means watching the market without emotional attachment. It means separating information from impulse. When you react emotionally, you become predictable. And predictable behavior is always punished by the market. The crowd buys when excitement peaks and sells when fear reaches maximum intensity. The minority pauses, studies, and waits. Every price movement carries information. Each candle represents the battle between buyers and sellers. Emotional traders see only profit and loss. Observers see strength, weakness, imbalance, hesitation, and momentum. This shift in perspective transforms the way you interact with the market. When price suddenly rises, beginners feel urgency. They chase entries, afraid of missing out. When price drops, panic sets in. They exit at the worst possible time. The minority does not rush. They ask calm questions. Is this move supported by volume? Is this happening near a key zone? Is this a trend continuation or exhaustion? That pause creates clarity. Observation builds patience. You stop forcing trades and start waiting for alignment. You wait for structure. You wait for confirmation. You wait for probability to favor you. This waiting feels uncomfortable at first because the human brain wants action. But discipline is built inside this discomfort. Another important part of observation is emotional detachment. You are not your trades. You are not your profits. You are not your losses. When your identity becomes attached to market outcomes, every fluctuation feels personal. A red candle feels like failure. A green candle feels like validation. This emotional roller coaster destroys consistency. Detachment allows you to see the market objectively. Professional traders do not try to predict what will happen next. They observe how the market behaves right now. They watch reactions at important levels. They study how price responds to buying and selling pressure. Instead of guessing direction, they respond to behavior. Observation protects you from overtrading. Many beginners believe that being active means being productive. They constantly open positions, check charts every few minutes, and feel uncomfortable staying out of the market. The minority understands that doing nothing is often the most profitable decision. Capital preservation is also a form of profit. Another benefit of observation is improved risk control. When emotions are calm, you respect stop losses. You don't widen them out of hope. You don't increase position size after a winning trade out of excitement. You follow rules instead of impulses. This consistency compounds over time. Many traders overload themselves with indicators, signals, and strategies. This creates confusion and emotional stress. Too much information leads to paralysis or impulsive action. The minority simplifies. They focus on price behavior, market structure, volume, and context. Simple observation beats complex noise. Long-term investors also need this skill. Instead of reacting to daily news, social media opinions, and short-term volatility, disciplined investors observe business performance, earnings growth, management quality, and long-term trends. This prevents panic selling during market corrections and crashes. Observation improves timing. Emotional traders chase price. Observers let price come to them. They wait for pullbacks, consolidations, and confirmations. Better timing reduces risk and improves reward potential. One powerful habit is separating observation time from execution time. During observation, you analyze calmly. During execution, you simply follow your predefined plan. This separation reduces emotional interference and improves discipline. Journaling strengthens observation skills. Instead of recording only profit and loss, write what you observed: price behavior, volume reaction, emotional state, and decision reasoning. Over time, patterns become clear. You start seeing repeated market behavior and personal emotional triggers. Markets reward emotional control more than intelligence. You can memorize every technical indicator and still fail if emotions dominate your decisions. Observation trains discipline through awareness. As this skill develops, you begin recognizing market phases: accumulation, expansion, distribution, and contraction. You stop guessing and start understanding structure. The market no longer feels random. It becomes a system of repeated behavior patterns. Observation also protects mental health. Emotional trading creates anxiety, stress, burnout, and frustration. Calm observation creates stability and confidence. You stop tying your self-worth to short-term results. The minority does not rush. They watch carefully. They wait patiently. They respond logically instead of reacting emotionally. This is not a quick skill. It takes repetition, discipline, and conscious effort. But once mastered, it becomes your greatest advantage. If you can learn to observe without reacting, you will stop fighting the market and start working with it. You will no longer be controlled by price movement. Instead, you will become a calm decision maker in an emotional environment. And that is what separates professionals from amateurs. That is what separates the minority from the majority.